Topic 4 continues our backwards look at the accounting cycle. As you see on your screen, these financial statements represent the end of the accounting cycle. We're not going to backtrack one step and look at where some of this information comes from. First of all, if you look at these accounts, these items are called accounts in the accounting world. These are accounts, these are accounts, owner's equity is an account, total sales is an account, and these expenses are accounts. So these are all accounts in the business. So the question becomes, where do these amounts of money for all these accounts come from? And that's what we'll be dealing with today. With these assets and these amounts, the liabilities and the owner's equity, all of these accounts come from someplace. And if you backtrack one step, if you remember the accounting cycle, the step just prior to the construction of the financial statements would be the general ledger. We start with transactions, they're put into a journal, then into a general ledger, then into these financial statements. So we're going to look at the ledger in a bit in this topic, not today, but we're going to get to the ledger a little bit further on. What I want to look at today is a concept that's very important. So this particular video will be pretty crucial to not only this topic, but for the rest of the work that we do. So it's really some fundamental information that you're going to need to understand. So I would suggest you repeat it if you need to, take notes if you need to, refer back to it, but you'll need to understand the concept behind this. So I'm going to look at the tabs at the bottom. We've done this before. You see at the bottom we have this tab that we're on right now called statements. Then we have assets, liabilities, owner's equity, revenue, and expenses. And we're going to look at each one of these. Let me click on, first of all, assets. Now that would be, in this particular business, the XYZ company, these are the assets. And we call these the asset accounts. And different businesses obviously have different asset accounts, but for this business, we will be using these. So if I click on this, you see something that looks a little odd probably, but this particular page will be, again, important, and we'll look at the same kind of thing with the other accounts as well. To understand the general ledger, we look at something called T accounts, and we call these T accounts because if you look at what I'm pointing at, each account is looking like a T. And there's something called a debit side and something called a credit side. Two very important terms. It's important for you to understand that the word debit does not mean debt, as in when you incur a debt. If you owe somebody some money, you have a debt. That's not what this means. This is debit, D-E-B-I-T. Debit side in accounting simply means left. The left side. That's all it means. Just remember that debit means left. Credit is not the same thing as a credit card might mean. And I know that may be confusing, but in this field of accounting, you have to understand that the word credit side, the two words, in this case means right side. So we are looking at what's called a skeletal view of an account. And in an actual general ledger, this will be looking a little more formalized, but right now we just want to get the concept down. So there will be something in a general ledger, which is a book. There'll be literally a page that will be titled cash account. Okay? So on that cash account page, there will be two sides. There will be a left side and there will be a right side, a debit side and a credit side. So in the ledger, and we'll explain how this works later, but in the ledger, when cash increases, if we somehow get more money, somebody pays us money, eventually it ends up in the general ledger in this page called the cash account, and it will end up on the debit side. And the debit side of any asset, including cash, shows increases to the account. If we spend money, if cash goes out of the business, it's going to show up eventually in both books, the journal and the ledger, but in the ledger, it's going to show up on this page called cash account, and that decrease in cash will be shown on the credit side. So the debit side of any asset shows increases to the account. The credit side of any asset shows the decrease to that account. So that's an important concept. Now I've shown the other accounts that were listed on the balance sheet of this particular business. These are all assets. These are all things that the business owns. So this is what you have to try to visualize. These are, in effect, pages in a ledger book, and there's one for cash, there's one for accounts receivable. Remember, that's going to show what people owe to us. So if they owe us more money, it will be shown on the debit side, which shows increases. They owe us more money. When they pay us, then that means this account goes down because they owe less money. Somebody, one customer anyway, owes less money. If that happens, that amount would be put on the credit side of the accounts receivable account, and that would mean a decrease. So people owe us less money because they paid it. Inventory, again, we get more money. We get more inventory. It increases, shown on the debit side. If we get rid of inventory, and we want to do that, obviously we want to sell it, and we'll show you how to do that later. But if we get rid of inventory, it goes down. We show it on the credit side, which shows decreases. And I could do the same thing with office building. If we buy it, a building, we show it on the increase side. If we would sell the building, we would show it on the decrease side. And that would be the same thing with office furniture, computers, supplies, and delivery truck. An important concept. Liabilities, the next tab at the bottom, these are different. These still are looking like T accounts. And again, we're visualizing kind of a skeletal view of the ledger. Accounts payable are liabilities. These are things that we owe. Now, it also has a debit side. Everyone has a debit side and a credit side. Every one of these liabilities has a left side and a right side, and every one of the left side is called the debit side. Every one of the right side is called a credit side. That never changes. What does change is this. In any liability account, the debit side, the left side, shows decreases to the account. The credit side shows increases to the account. So if we buy more things and charge them, we owe more money, so that's an increase to accounts payable. If we pay off that accounts payable, that means we owe less money. That would decrease accounts payable. That amount of money would be somehow shown on the left side, the debit side. The mortgage, again, works the same way. So does loans payable. So does the loan for the computers as well as the truck. So let's take computers for a second. If we buy more computers and we charge it, we owe more money for computers. We put it over here on the increase side, which is the credit side. When we pay that, we owe less money now. So we pay part of that loan. We owe less money. If we did that, we would show it on this side, the decrease side. So liabilities, again, always have a debit side and a credit side. Debit is always left, credit is always right, but the decrease side, the increase side are just the opposite of assets. Owner's equity, again, has two sides, debit and credit. If we increase owner's equity from month to month, it would be shown over here. If we have a net loss sometime and we decrease it, it would be shown on the decrease side. So this kind of looks like liabilities as far as the increase side and the decrease side. Revenue, again, same as far as debit and credit, and same increase side on the credit side. If we make more sales, it would be shown over here. If we make fewer, if we somehow lose sales, for example, if we have to refund money because somebody returned something, it would be shown on the decrease side. So sales also has a debit side and a credit side. Almost always it would be on the credit side. If we make a sale, it would be shown on the increase side. And finally, expenses. This company has a number of expenses, as you can see here. Rent, advertising. We have rent, advertising, gasoline, oil, electricity, and way over here, heating expense. Expenses always have a debit on the left, credit on the right. So no matter what kind of account you're talking about, it always has a left side called the debit side and a right side called the credit side. On any expense, the debit side always shows increases. The credit side always shows decreases. So, for example, if we pay more money for advertising, if it costs us more, it increases. So we increase the advertising because we spent more money on advertising. That is shown on the debit side. For some reason, if we decrease advertising, it's shown over here. I might tell you this, expenses rarely have a credit. Theoretically, it could happen. We could have money refunded, I guess, because we didn't get the advertising we thought we paid for, and it would decrease, but that's rare. So expenses typically are debited, and that's shown on the increase side. Okay? So that whole concept with expenses, with revenue, with owner's equity, liabilities, assets, all reflect back to accounts, which we found at the beginning on our financial statements. At this point, I would remind you that it would be important to review this, take notes if you need to, copy down those things called T accounts. You'll need to know what assets are, liabilities, owner's equity, revenue, and expenses, but you also need to know the increase sides and the decrease sides. For all the accounts, debit always is the left side, credit is the right side. That's easy. But the increase side and the decrease side vary from account to account. So you need to spend some time memorizing that. You're going to have an exercise to follow this that will deal with that. So at this time, go back to your course page and go on to your next assignment.